Um, as our colleagues kind of trickle back in here, I appreciate everyone's indulgence and quick lunch. Our next presenter is Jared Walczak from the Tax Foundation. I appreciate you flying in for this hearing, and I will turn it over to you to begin your presentation.
Well, thank you, Senator, members of the committee. I really do appreciate the opportunity to be here in person. These days in particular, it's really nice to testify and speak in person. We've had less and less of that. And I know, of course, I'm speaking right after lunch. That's one of the worst times probably to speak on tax policy. So I'm grateful for you for all coming back in and wanting to talk about tax policy right after you had lunch. I'm here to discuss this in part because we had written on some of these issues as Mississippi was looking at some tax reform options earlier this year during the legislative session. In fact, we had written somewhat critically, perhaps about some of the particular elements of the House proposal. So I wanted to come here and take a step back and talk about what's important here, to talk about why tax reform can be a really good thing and really pro-growth and something that Mississippi should be very seriously taking a look at, and then talk about the why and the how. So wanted to take a little time on that. But firstly, to set some context here, because there has been some discussion already today about where Mississippi ranks among other states on the income tax and on other taxes. And there are 9 states, of course, that have no wage income tax. One of those has a little asterisk that New Hampshire currently taxes non-wage income. They tax interest and dividend income. They're in the process of repealing that. So pretty soon it'll be no asterisk. 9 states just don't tax individual income. Additionally, then, Mississippi, of course, has a top rate of 5%. And there was a question earlier about where that ranks. And there are 13 states, including Mississippi, that are at 5% or lower for the top marginal rate. So you're now at 22 states at 5% or lower for top marginal rate. So you're pretty close to the median. You're a little below it, but not by much. And more importantly, 10 states cut their individual income tax rates this year through legislation. Now, some of that will be phased in, some has already taken place, some will take place next year. But 10 states enacted individual income tax cuts this legislative session. There's an 11th, North Carolina, that's looking at further reforms perhaps later this year. Because of that, there will be an additional 4 states that have rates at or below 5%. So within a couple of years, assuming no further changes, the median rate nationwide for the top marginal rate will be 5%, right where you are. You'll be right in the middle. And being in the middle isn't the worst thing in the world, but it's not the best either. And I think that a lot of states are looking for opportunities to enhance their competitiveness, to stand out, to find ways not only to send the message that they're a state that is attractive for migration and economic growth, but also to capture a moment. One of the reasons we saw so many states cutting income taxes in the last year is because of the rise of remote work. Increasingly, you do not have to work where your company is located. And companies themselves do not have to be located where their entire workforce is located. There's an opportunity to disaggregate these, and we're seeing already more migration. We don't know exactly what that will mean because, of course, right now we have a lot of temporary migration that will snap back. No one believes that everyone who left the major cities will never return. But nonetheless, there's pretty clearly an out-migration away from some of the nation's larger cities and financial capitals to the rest of the country, and an opportunity for states to compete on this measure. So we have a lot of states that are very interested in income tax reforms. And again, I think that there's really this emphasis on how can you get rates low, or how can you even really send a message and eliminate an income tax. You're not the only state that's looking at that. Several states have been looking at that. And we see the evidence in a number of things for lower income taxes, less reliance on taxes on income rather than on consumption. We see, for instance, that among the 9 states without an individual income tax, the rate of population growth is more than twice the rate of population growth in the rest of the nation. We see a significant net migration out of the states with income taxes to the states with no income taxes. We also see the same effect for states with low income taxes versus high income taxes, that there is a resorting, and there's every reason to believe that resorting is going to get even larger now with the, both the increase in migration and obviously, although it's for now temporary, the elimination or the cap of $10,000 in the state and local tax deduction. But the big element here is very much the ability to potentially work in far more places. The individual income tax, it's important to think conceptually why this matters, why there's a difference between a tax on income and a tax on consumption or a tax on something else. Because whatever we tax, we get less of. And we have to tax, and we have no choice in this matter. We need to raise adequate revenue to fund the state's priorities. But when you think of the different things you can tax, a corporate income tax is taxing capital, it's taxing investment, essentially. An individual income tax is taxing a couple of different things. You can think of it taxing, largely speaking, labor and individual investment. But there's another way to think of it too that I think is really helpful, because ultimately the income tax and a well-structured sales tax are falling basically on the same people. But there's a difference nonetheless, because the sales tax as a tax on consumption is on your present consumption. The income tax is on your present and your future consumption, because it's a tax on the savings that you will eventually presumably spend. So it's in some ways, in this sense, a double tax. I don't mean to say it's literally double taxation, but you're taxing consumption, both present and future consumption, through the income tax, and then you're also taxing present consumption through the sales tax. So if we are having an effect on discouraging some economic activity, which you're going to do with any tax you choose, you have somewhat of a choice. Do you want to tax the investment? Do you want to tax the labor? Do you want to tax the savings? Or do you want to focus more on consumption? And most of the states, of course, have said that for a variety of reasons, we balance these things. Only 9 states do forego an individual income tax altogether, but they decide how to balance them to address a number of different priorities. They want economic growth, they want fairness, they want revenue stability. They're looking for a lot of different things in trying to find that balance. And the states without an individual income tax have done it a variety of ways. Some ways you cannot replicate. You will not have the oil fields that Alaska has. That's just not an option for you. But on the other hand, there are states, whether it's Texas or Florida or Tennessee or New Hampshire, that have done it with maybe a little less of an unusual economy. Florida obviously has significant tourism, which does help a lot. But a state like Tennessee, a state like New Hampshire, a state even like Texas, more diversified economy, but has been able to change its tax approach in a way that is more competitive for investment and growth. Because one thing I want to emphasize here is that the rates matter, because there's been a discussion of different ways to phase this in. And I think there's a lot of different ways you could try to reduce income taxes. You can create higher and higher exemptions. You can create lower and lower rates. You can do both, and both might be a viable solution where you're sort of phasing them in towards each other, reducing rates while at the same time raising exemptions to make sure you're providing significant relief for the lowest income taxpayers as you're doing this. But one reason why I do say rates matter is that margin is where investment decisions are made, including for your small businesses. And 97% of all businesses in Mississippi are pass-through businesses, meaning they're paying through the individual income tax, not the corporate income tax. This is where most of the business revenue is from. This is where most of the business activity is from. This is where probably a majority, not 97%, but a majority of the employment is from, is these pass-through businesses. And they very much care about the marginal rates. Obviously, given that it kicks in at $10,000, there aren't a lot of active small businesses that aren't paying the top marginal rate on most of their income. And they very much care about that rate. There is certainly an opportunity to, try to make the state more competitive for businesses and, to try to create that economic growth that's associated with that. There's also a simple factor that might seem a little silly, but rates matter because just the sticker rate is meaningful to people. People and businesses are not always sophisticated decision makers. We would like to think perhaps that every time that a business or an individual is thinking about options for relocation, that they would be looking at all of the details. But I've talked to a lot of site selectors, economic development officers, and there's a first pass and a second pass. And in that first pass, they're looking at really top line numbers. They're picking 5 states perhaps based on some really simple figures, like what's the top marginal rate for individual income tax, for corporate income tax, what's the effective property tax rate. And only then, once they've narrowed it down to a few states, are they going to go to maybe a consulting firm or an accounting firm and say, crunch the numbers for us. So there are states that say, well, when you get past the rates, when you crunch our numbers, we're pretty good. And that's sometimes true. But they're missing out on some opportunities that are really associated with being able to advertise we have a low income tax, we have no income tax, that there's some way that we stand out. So states have been able to capitalize that on that in some really important ways that I think are significant. There is a significant literature on consumption versus income taxes, taxes that we can think of as more taxes on production, as on investment, on that sort of business activity and individual investment activity. My organization, the Tax Foundation, does have resources on this. We've published some literature reviews, which I think is the best way to approach that, saying, here's what the broad economic literature says on this, so that individuals can assess that it's not just the Tax Foundation saying it. Here's the evidence. And there are some conflicting studies, but the vast majority of studies out there will tell you that income taxes do reduce GDP. That, especially at high rates, that they have an effect on job creation, and that they have a very significant effect on migration. And we'd be glad to provide those. We have a couple of publications on that we would be happy to send to the committees, provide that information. But, you can just look at studies at the international level. The OECD has done a number of studies on this, on income taxes versus, yes.
Would you pull your microphone up a little bit? I think people are having a hard time hearing. There you go.
Is that better?
Much better.
So at the international level, the OECD has done significant research on this question, and routinely finds that consumption taxes are more neutral in their application. They have less of an impact on economic growth and decision-making than income taxes, which create a certain amount of distortion, which reduce investment and also have an effect on migration. And we see the same thing repeated in studies at the national and at the state level. So I think there really is an opportunity to look for ways to enhance the state's competitiveness through income tax reductions, or even, as has been proposed, elimination. What I do want to emphasize is that the goal is always economic competitiveness, economic growth. In some ways, reducing or eliminating the income tax would be an instrumental goal, not a final goal. And therefore, not all pay-fors are created equal. Not every way to do it would be prudent or would be pro-growth, because you need to be able to cover the revenues. You need to be able to have certainty and stability in this. And you want to make sure that what you're taxing is not harming the economy in ways that the existing income tax was not. And I think there's been some very careful consideration here over the last year, as the changes from the introduced version of the House bill, for instance, to the version of the House ultimately moved forward on, and continued deliberations in this committee and with other members. Particularly, I want to emphasize the role of business inputs in the sales tax. Every sales tax in the country has intermediate transactions, business inputs, included in the sales tax base to varying degrees. If you asked most economists or public finance theorists, they would tell you that every sales tax should just be on final consumption. They'd probably tell you it should be on almost all final consumption, any retail transaction, but that it should exclude all intermediate transactions to avoid tax pyramiding, where the same tax is embedding multiple times over in the production process. In the real world, no one has that sales tax, but there are still differences from state to state. You, of course, have the ordinary number of business inputs that are included in the sales tax at the ordinary rate. You also have a number of business inputs that are less frequently taxed, that are taxed at lower rates. And it's easy to think of those as preferential rates. You're giving a preference, but the reality, of course, is that most of your peers aren't taxing them at all. So things like manufacturing machinery taxed at a low rate. But that's not really a preference if you understand the sales tax as being on final consumption, and manufacturing machinery is not final consumption. Almost no one probably buys machinery because they want to enjoy the machinery. They're trying to produce something for sale. And one significant aspect of taxing business inputs is it changes the way that the sales tax is structured and who pays it, and it has therefore a competitive impact. Sales taxes are usually destination based. They're paid by the purchaser, and they are and the tax is remitted to the jurisdiction where the purchaser lives or is consuming the good or service. This is the typical way that they work. But of course, this sort of gets reversed with business inputs. They're taxed where the business activity is taking place, not where the ultimate consumer of the good or service that is created is. And therefore, it puts businesses in Mississippi at a competitive disadvantage because their peers do not pay those taxes in their states. So if a Mississippi business, let's say, that business is selling to a state with lower sales tax, they're not at a competitive disadvantage selling to customers in that state because that person's paying their state sales tax, whether they're buying from, say, a Louisiana business or a Mississippi business or any business. But if that Mississippi business had to pay sales tax on its manufacturing machinery, if it had to pay taxes on its commercial utilities, if, say, there were a change in the sales tax code and they had to pay for professional services or a variety of different things that could theoretically be included in the sales tax base, those are taxes that typically aren't going to be imposed on their competitors in other states. Now, if they're selling something that easily crosses state lines, the law of one price basically comes into effect. They can't really raise their prices that much because their peers haven't, but it puts them at a competitive disadvantage. Either they're priced out of a market, or their margins are lower, or they need to distinguish themselves in some way. I mean, companies do. Companies face different costs, but it puts your businesses at a disadvantage in a way that just the sales tax rate on its own really doesn't, because everyone in Mississippi is paying a sales tax rate and everyone in another state is paying their rate. So it's something that states have tried increasingly to avoid. Every state, again, has a lot of these business inputs embedded, but many states over the last 15 years or so particularly have made a pretty concerted effort to try to get some of the more egregious ones out of sales tax bases, while at the same time often making at least marginal improvements in the breadth of their base on personal consumption, particularly as we see changes in personal consumption as we're all consuming more personal services, or we're shifting something from purchase of a good to something being a subscription service, or something that has changed its nature in some respect. Obviously, some of the discussions early on were very much about taxing business inputs, and that's not unusual. States that are looking at significant pay-fors for income tax or for any other reduction look where the money is. And if you open a tax expenditure report, you see an awful lot of money listed under the sales tax on services, much of which is business inputs. So I very much commend the legislators who looked seriously at that and said, maybe that isn't the best approach, that maybe that is not a very pro-growth way to do that, because you're taxing directly business activity, you're taxing investment, you're taxing capital accumulation in the state through a tax that's supposed to be a tax on consumption. It sort of ceases to be a tax on pure consumption when you are taxing that way. So it's been good to see that there has been a shift in that approach, but I would just say that remains a very important factor, that if the goal is to be pro-growth, you want to make sure that you are not taxing that sort of investment activity, that you're not penalizing businesses for choosing to actually do business in the state. I want actually, I'm talking and I know that, again, it's right after lunch. I want to make this more interactive. If there are questions, I'm happy to take them along the way. So there's one, there's a lot of, yes, all right.
Senator Bryan, I'll get you in just a second. I think Representative Johnson had a question.
My first question is, do you talk that fast all the time? Or are you really trying to catch a flight? Because you're going to make it, I tell you. I guess this question was asked of me. It's been asked of me a couple of times because I voted for this bill, and so I've had to explain myself on a number of occasions. But the one question, you said something earlier, and this question been posed to me. You said a cut in income and reducing or getting rid of the income tax would help with migration. You'd have more people moving into the state. Is that your?
Yes, Senator, that's what I mean.
So how do you explain that the state north of us doesn't have an income tax, but our fastest growing and most populous county, one of the most populous counties, DeSoto County, people are leaving Memphis to live in Mississippi? Doesn't that speak to the fact that there are a number of factors that play into this and not just income tax? And my follow-up question is, I espouse the idea that we need an overhaul of our tax system. Does your organization support the idea that not just cutting like income tax or cutting corporate tax, but do you all have a overall theory, overall plan, as these economists have said to us, that takes into a number of factors and overall tax reform as opposed to just cuts? What is your position on that? And explain, the first question is, how do you explain people leaving a non-income tax state to come to a state like Mississippi and populate the county at an alarming rate right across the border?
Senator, very good questions. And I will do my best to answer them. And I may struggle with Memphis as an example in particular. I can tell you that we do see significant in-migration into lower income tax states and into no income tax states overall. That doesn't mean, of course, that you're not going to see, growth in certain, metropolitan or non-metropolitan areas that have income taxes. There are a lot of factors. And let's take a step back on that. There's a lot of things that businesses and individuals care about when they're thinking about where to live, where to work, where to grow a business. Taxes are an important part of it. And they're the part I talk about mostly because I work at an organization that focuses on taxes, but they're definitely not the only part. Businesses and individuals care about the quality of life. They care about the cost of living, which is taxes are part of that, but it's not by any means the only part of that. They care about good schools. They care about services. They care about an educated workforce. If they're a business, they want all of those things. And it's a balancing act. Just eliminating all of your taxes would cut some things that are really important, and no one would be rushing into a state that just said we're going to zero on everything just because we can go to zero. It is a balancing act, but we do know that within any given revenue goals, there are better and worse ways to raise a dollar for economic growth. And even within that, economic growth is not the only thing you prioritize for. So I'll give you an example of that, and there will be probably different views in this room on this, but of course, Mississippi exempts retirement income from the income tax. I don't think you would find an economist who tells you that's pro-growth. You'd find a lot of people who say, we like that as a policy because we care about it for some other policy reason, that we want to make sure we're providing for fixed income retirees, that we want people to relocate to the state to remain here. Like there's other reasons you may choose that.
That's exactly what we've been, migration. Again, people who are elderly will move here because we don't tax retirement income.
And on that question, sir, so there's migration of sort of working age adults who are going to be investing in the state, growing the economy. And that is usually where states are really hyper-focused. A lot of states want to retain their retirees. They don't want people to feel like they need to leave the state when they retire. But states are reducing their emphasis generally on trying to attract most retirees. Now, there are states like Florida that focus, or Arizona, that focus on tracking a billionaire retirees, and they bring a lot of revenue to the state. Retirees generally do not bring revenue to the state, they cost revenue. So you care about it. It's a policy choice because you say, we want people who lived and worked in Mississippi to spend their life here.
But your recommendation would be to look at the entire tax plan and find what suits us. Make sure we have adequate revenue, make sure we meet our needs, and maintain at least some stability. Everything the economists tell us to do.
Absolutely, sir. You need revenue stability, you need predictability, and there are ways to address that.
Thank you.
Senator Bryan.
Thank you. I do think a number of us are literally having trouble understanding you because you're speaking so quickly.
I apologize.
I started to say you're not from here, but I thought that might have a bad connotation. We wish you'd stay longer. You seem anxious to get on this plane to leave.
I do apologize.
There's no pro rata income tax that's going to be imposed on you for 1/365th of your salary if you stay overnight. I've been looking at the statistics from the Tax Foundation for a number of years, and I've been looking at your ranking of states in terms of their business tax climate. I know that there are 5 taxes, but exactly how do you determine the income tax? Is it by top maximum, by the top rate, or by the or what? In the same way with corporate taxes and others.
Yes, sir. Senator, I appreciate the question. So we have a publication called the State Business Tax Climate Index, and that is a structural ranking of states' tax codes. So it is taking the 5 major taxes, individual and corporate income taxes, sales and excise taxes, property taxes, and unemployment insurance taxes. And then it is taking, I think it's now 128 variables, and using that to assess the structure, not the collections of these taxes. So the individual income tax rate is a variable. It's one of 128 variables. It's one of about 30, I think, that are in the individual income tax section. So we're looking
Excuse me, but you mentioned the rate. So is the income tax factor based entirely on the maximum rate?
No, sir. If I understand the question, the income tax section is based largely on it's the rate is part of it, but the base is a significant part. It's a question of the structure of the tax. It's, for instance, the fact that you have a marriage penalty. It's a small one because you have you only have three brackets that kick in pretty quickly, but they're not doubled for married filers. It's based on things like it's how you treat different classes of income. It's indexation. It's a lot of different features of the income tax code. So it's more focused on the structure than it is just on the rates. The rates are absolutely part of it. I don't want to mislead on that. The rates are an important part of it, but the index is looking at way more. It's looking at how you design the code.
Well, I've always been bemused at the states which have the overall highest rank on your business climate. And I'm going to show you what I put together sort of hurriedly. And I apologize for just throwing this together,
Okay.
but I'm sure you have to be familiar with this.
Mhm.
If you look at the top 5 states, would you say have the best business climate? They're Wyoming, South Dakota, Alaska, Florida, and Montana. Generally speaking, they rank about in the middle or on the per capita income rank, and at GDP per capita, they average out a little bit below the median. But then you go to the 5 states that you say have the worst business tax climate, and they're New Jersey, California, New York, Connecticut, and Minnesota, which are among the wealthiest states in the nation. They have one of the highest per capita incomes, and their GDP per capita is also right at the top. So how can it be that the states which you say have the best business tax climate are performing just at best on average, and the worst states seem to have a huge amount of wealth?
Thank you. It's a very important question, and one that we do address in the publication, but I'd love to just walk through very briefly. Because we're looking at the structure of the tax codes, we're not looking at everything else the state does on business. We are looking at structure of tax codes. So you take a state like Wyoming. It has no individual or corporate income tax. That means there's no problems with the structure of its individual or corporate income tax. There's nothing they're doing wrong within those taxes. That means they're going to do very well on an index like this. That does not mean that Wyoming is a state that necessarily every business is going to go invest in. There are a lot of other reasons why that's probably not going to be your choice. At the same time, you look at a state like New Jersey. New Jersey has a lot of advantages, as does New York. I mean, New York is the financial capital of the world. There's a lot of investment that's going to be in New York, despite not only high taxes, but an insanely high cost of living and lots of other things that people would probably think of as negative. In fact, if you imagine, if you took New York's or New Jersey's tax code and their tax rates and you put them in Mississippi, that probably wouldn't work. And I don't want to pick on Mississippi here. You put them in 30 or 40 states and it probably wouldn't work because the balance just wouldn't work. That an individual wouldn't be willing to accept a 10.9% top marginal rate to live in most states. It's honestly, it's getting up into like 15% when you take New York City's income tax into account. Most people would not accept 15% state and local income tax top rate to live in the majority of states. There are people willing to do that for New York City because the city has a lot to offer. Not things I personally want. I don't want to live in New York City, but there are people who clearly do. And they're also willing to pay $5,000 for efficiency apartments because there's something about the city that makes it work. What we're measuring is not a broader measure, and there are broader business measures and broader competitiveness measures that other organizations do or that you can get from CNBC or others. We're looking at the structure of the tax code. So New York's structure is not a very competitive one. They've actually made some improvements recently, but it's not a very competitive tax code. And if you put that in the median state, it could be devastating, to be honest. They have enough that's balancing that. And we're not saying they don't. We're saying that the tax structure is not ideal. And I think that if you go through the tax structure of like a New Jersey or a Connecticut, we could find lots of examples of things that are harming their economy, even despite that, they're clearly doing quite well.
Well, you seem to be saying, which to me is just common sense, that both individuals and businesses migrate to areas for reasons other than tax structure.
I am. There's a lot of reasons, but you also look at New York, New Jersey, California. I mean, this list, these five states, those have some of the highest out migration of any states in the nation right now. I think California leads. New York is getting up there and may leapfrog them this year. There's a lot of things to attract people to New York, but their tax code, their cost of living, their regulations, lots of other things are driving people out. I don't think they're a model to emulate on the tax front.
But you say people are being driven out of New York. New York City gained 800,000 people during this last census. And if you move to New York City, you have the privilege of paying, I believe, a New York City income tax. And so notwithstanding your explanation of the very high cost of living in New York, the very high taxes people pay in New York City, they're moving to New York City. So what I'm concerned about is the mantra that we hear over and over, that if we'll just abolish the income tax, that'll do it and folks will flock here. And you mentioned earlier the retirement income tax, which exempts retirement income, not all income, but retirement income. And if you're over 65, by the time you get all your exemptions and all, you're doing right well in Mississippi. I remember clearly when that was being sold, and we were told Florida doesn't have an income tax. Retirees were flocking to Florida. And if only Mississippi would not tax retirement income, we would be competitive with Florida as a retirement location, which I thought was sort of laughable on its face, but you seem to be making that same point.
Sir, on the retirement issue, I think that I was trying to say that is a policy decision that probably wasn't primarily about economic growth. It does have an effect on migration of retirees on the margin, but retirees are looking for a lot of things, including a state that is probably growing. I think that there does need to be an emphasis on growth. The Independent Budget Office in New York City has been putting out reports for the last couple of years that are kind of crisis mode on what they see as the outmigration of the city. And you're right that the census numbers gave them a sense of relief because they had, I think, 600,000 people added to the city over the decade, and they thought it was only be 400,000. So that's a big deal. But I do think that a lot of these major cities are very concerned right now. I forget how many hundreds of thousands of people left New York City that haven't come back yet during the pandemic, but a fair number of them aren't going to come back because they have this flexibility to work anywhere. And again, tax rates matter. They're not the only thing that matters. Tax structure matters. It's not the only thing that matters, but it's something that's within your power. It is something that you as a legislature are able to do. You can't necessarily, and probably don't want to, make Mississippi New York, but you can do something about the tax code to make the state more competitive.
Well, I understand you're saying that this retirement income was a policy choice, but believe me, I was here and I painfully remember the arguments that were being made that suddenly we would snatch up people from Florida because, why wouldn't you come to Mississippi to retire? I just have one other question, and I think that you're helping me get this clear, but let's say there are two states, two identical states, and they're having a problem maintaining their roads because they've been relying on the gasoline tax. Mm-hmm. And don't you know, cars are getting better mileage and it's a fixed amount per gallon, and we've got inflation, and now they've got these electric cars that don't burn any gasoline. Mm-hmm. So what shall we do? And one state takes the position, roads are a common good. Everybody needs roads. We'll take 20% of our income tax receipts, divert them to highways. And we think that'll fix things for 10, 15 years. We'll all be out of office by then, but it's about the window you can reasonably grasp. So they decide what we're going to do with our highways is we're going to divert 20% of the income tax to it. State B or 2, whichever one it is, the other state says, no, we're going to live within our means. And we're going to have a 20% income tax cut. Now back to the roads. They're just going to have to get by, just like families have to live within their income. So we've looked at this and we think about a quarter of the state highways will just turn back into gravel, that we can't really afford to keep them paved. And so we'll just let them revert to gravel roads. And then we've got these 4-lane highways, and we've got a bunch of them that we'll just go back to having 2 lanes and let 2 lanes revert to nature or whatever. And so that state, which is letting its roads deteriorate, would show up better on your business tax climate index because they cut income taxes 20%.
The state business tax climate index is a measure of tax structure. It is not a measure of road quality or anything else, but also, states, honestly, you have an your gas tax is about 18 cents a gallon. I think you might actually match the federal rate. It probably needs to be higher at some point. You have an issue, like many states do, with funding for highways, and highway funding matters. I don't think that there is a scenario where anyone's going to let their interstate highways be turned to gravel, or that the federal government would allow that. But yes, something that's measuring taxes is not going to measure your roads. That's not what it's for. There are other indices that will measure roads, but what we're discussing here also isn't something where we're cutting revenues by 20%. Any of the proposals being discussed are, I think, shooting for revenue neutrality. And I'm not here to endorse a particular proposal. I'm here to talk about the trade-offs associated with that, but I'm talking about them with the understanding that the plans are supposed to be revenue neutral and then to take a share of future growth, not to slash spending, not to eliminate road funding. And I don't think that is something that maybe any members have been discussing, to my knowledge.
Well, I mean, I think the tax climate index is useful, but it's the problem is when you're not here to explain this, however quickly and rapidly you're explaining it, when you're not here, it sort of transmogrifies into this is a ranking of good and bad states or whatever. What you're really ranking is an index based on the premise that, number one, you're better off with not having an income tax, or alternatively a low income tax, and relying more on a sales tax and various other features. But what it measures is based on your beginning premises. Is that a fair statement?
It's based on the economic literature and on the competitiveness of different aspects of the tax code. And there are states like Indiana, North Carolina, Utah, and others that are top 10 states in the index that have all of the major taxes. There are other top 10 states that do forego an individual income tax. All of these, though, have found ways to be competitive in that, that overall tax environment. And that's what we're measuring. We're not measuring everything. We're not measuring all of the other economic measures that obviously matter. We're looking at taxes. And that's one reason why the index is a component of a lot of broader indices that are out there that look at broader business climate or broader economic climate, because we're looking at tax structure. But the key is you can do really well on something like the state business tax climate index with all the major taxes, or foregoing one of them, or doing any combination of things. It's about how you structure the taxes. It's not primarily a question of how much, it's a question of how.
Well, thank you. I appreciate very much your time and your responses. I appreciate the committee's indulgence. And if you miss that plane, we'll recommend some great hotels in and about this area. And if you stay overnight, that will have a positive impact.
I will stay as long as I need to answer questions.
Representative Bain.
Thank you, Mr. Chairman. Jared, thank you for coming. And I know you've got to catch a flight. I'll be as quick as possible. I don't talk as fast as you do, but I will be quick. I want to provide you a little bit of context about me. I live in the far northeast corner of Mississippi. I think everybody in the room agrees that's the best part of the state. But we have, in regards to what Representative Johnson said, we've experienced kind of the opposite. We're losing people. I think the census has showed that we're losing people, and specifically, I can tell you, I live 3 hours from Nashville. The way I drive, about 2 hours. Okay, and then I live about an hour from Memphis. So our young people go up there quite a bit and stay there. And of course, I have people live right across the state line in Tennessee that don't pay an income tax. Okay, that have moved just 2 or 3 miles up the road. So I want to talk to you, and knowing that, and getting prepared for your testimony, I've looked at a couple of documents, and one of them was one that you put out in March 2021, talking about evaluating Mississippi's plan to phase out the individual income tax. Are you familiar with that?
Yes, sir.
Okay. All right. And in this plan, and I want to just kind of go as slow as I can, I guess. You talk about reducing reliance on the income tax that improves Mississippi's competitiveness.
Yes, sir.
Right. And I think you just testified that states that don't have an income tax have a double the rate of population growth.
That's correct.
Okay. And population growth in no income tax states will accelerate because of an increase in telework, this trend that we're going through with pandemics, telemedicine, whatever the case may be. Is that right?
Yes, sir.
Okay. All right. So the basis of that report, I think, was that consumption taxes, or what I gathered from it, again, I'm surely not as smart as you are, but what I gathered from it was that consumption taxes are better for the economy than income taxes. That's because income tax is both a labor and investment and reduces return on those both. Is that right?
Yes, sir.
Okay. So that's the Tax Foundation's position, is that that's a better way to tax.
It is, sir.
Okay. All right. Then on another document I looked at was one on May 21st of this year that the Tax Foundation put out, a report reviewing the economic literature on the effect of tax cuts on economic growth. You familiar with that one?
Yes, sir. I believe it was one of my federal team colleagues, Alex Durante, who put that together.
Okay.
Yes, sir. Yes.
And it kind of goes to Senator Bryan's points a little bit about it noted the measuring effect of tax cuts was difficult. It had to be done carefully, and you have to control other factors.
Yes, sir.
And that's what I really want you to kind of touch on, that just comparing income tax rates to state is really kind of difficult to do because things don't happen in a vacuum. Right. You have other factors that go into it. You don't have these controlling factors. Would that be a fair statement?
Controlling for those factors is very important, and there is a vast literature that attempts to do this, and it's getting better. I think that if you look over the last couple of decades, the economic literature on this question has done a much better job of trying to figure out what is associated with tax cuts or tax hikes and what may be outside of that realm.
But in your report on May 21st, it looked at top papers in economic journals.
Yes, sir.
And those were sophisticated studies that did control for other factors. Of those studies, it found that all 7 papers that were reviewed show that tax cuts have a positive impact on economic growth.
Yes, sir.
Okay. There was a footnote or something in there that referred to an economist named, I think it's Zidar. Is that right?
Yes, sir.
Yes. Okay. Well, we'll call him Zidar,
So.
which showed that tax cuts for low and moderate income taxpayers affect growth more than tax cuts for high income taxpayers.
I'm sorry, could you repeat it, sir?
Yeah. It's Zidar. He basically showed that tax cuts for low and moderate income taxpayers affect growth more than tax cuts for high income taxpayers.
Yes, sir. I believe that was the finding as one of the studies. That is a relatively anomalous finding in the literature, but there's a vast literature out there, and not every point is the conclusion of every study. What we do generally see is there's more of a consumption increase effect on tax cuts for lower income taxpayers, because to testimony earlier today, you are expanding capacity for consumption for individuals who are consuming a greater share of their income. Over a longer time horizon, investment in particular tends to be more associated with tax cuts for high income or higher income individuals, because that's where a lot of the investment in business activity is taking place. There's a pretty strong consensus in the literature on that, but as we've done this review or larger reviews that we've done in previous years, want to be comprehensive, and not every study has the same conclusions. There's a pretty strong prevailing trend in it, but there are studies that don't draw those conclusions.
Okay. And he also found that moderate income taxpayers increase labor force participation in hours worked. Would you agree with that?
Yes, sir.
Okay. And just to remind you, I know you're familiar with the House plan, that by year one, we're increasing the exemption so that taxpayers making under $40,000 a year won't pay those income taxes.
Yes, sir.
According to that report, and again, I'm trying to tie this back into living in Northeast Mississippi. According to that report, that will incentivize more people to work. Would you agree with that? The sort of tax cut that we're talking about incentivizes people.
Yes, sir. It incentivizes in a couple of ways. It potentially makes it more attractive to come to Mississippi to work. On the margin, it makes it more attractive to work more than doing now. It basically just it increases the return on your labor here compared to a higher tax.
So would it be fair to say when I'm presenting to my local Rotary Club or Kiwanis or whatever, that this plan is good and helps economic growth?
Reducing individual income tax liability for middle income taxpayers would be good for economic growth, sir. Again, I think it's important to other points that have been made that none of this happens in a vacuum. The pay-fors have to be responsible. The pay-fors have to also not have a more adverse impact on growth. So it matters how you pay for it. But yes.
Well, that's a yes. Okay.
Yes.
All right. Sales tax increase. You agree that replacing our income tax with some type of with a 2.5% sales tax increase in your report, you agreed that was pretty good policy.
Yes, sir. We thought that a rate increase as an offset could be a very responsible approach.
And that would put us on par with Tennessee, Alabama, and Arkansas, but we'd have a little bit of advantage over Alabama, Arkansas, and Louisiana, which is important to me because I live up there by Alabama and have to hear Roll Tide all the time. So that would put us in a pretty good spot.
You would certainly have a higher sales tax, but it would be very much consistent with a region that has higher sales taxes. Yes, and including Tennessee, which has a high sales tax and no income tax, and other states that have high sales taxes but still have the income tax. You'd be very competitive with them.
You talked about in your testimony earlier about some business inputs.
Yes, sir.
Your report said that we should not increase preferential rates on sales of business inputs on manufacturing machineries, farming, logging equipment, sales to EPAs, and sales to railroad operators. Now, you're familiar, we removed those in some
Yes, sir.
further part. We removed increases on farming, logging equipment, manufacturing machinery. And you're aware of that part?
Yes, sir.
Okay. Removing those, does that change your objection?
It makes a huge difference, sir. I think it's very important to be focused on removing the taxation of business inputs. The numbers self that out, but yes, sir, it is very important and a significant progress.
As far as taxing automobile sales at whatever that general rate increase to be, let me ask you this, okay? And you favor taxing automobile sales at whatever the general rate increases?
Yes, I mean, most states do tax at the ordinary rate for automobiles.
All right, tomorrow we're going to hear from a lady with One Voice Group. They prepared a report on the House tax elimination plan. Have you seen that report?
I've not actually. Sir.
That report has some claims about it, that how our House plan will impact different income brackets. Their numbers come from a model put out by the the Institute for Taxation and Economic Policies. You familiar with that model?
Yes, sir. It would come from their Who Pays report, I believe, sir.
Would you consider that model a reliable model for predicting the impact of our tax plan?
I think the Who Pays report has some data limitations that are important to understand. So it is a model that's trying to determine whether a state's tax code is regressive or progressive or where it falls on that spectrum. However, it does a number of things. One, it only looks at working age taxpayers. So it excludes retirees entirely. So the fact, for instance, that you don't have an income tax on retirees is just completely excluded from their analysis. It also exports a lot of the tax code. So it says, and this is right in a narrow sense, that a significant portion of, say, your corporate income tax, your taxes on investment, your commercial property tax, all of these are going to be borne by investors wherever they are in the country. So they export that. They say the vast majority of those taxes aren't paid in Mississippi. To a point, that makes sense. They never import anything else back in, though. So these just disappear. So when they're looking and saying that the tax code of a particular state is regressive, they're more or less not counting the corporate income tax, the commercial property tax. They are limited in how they're accounting for sales tax on business inputs. It is in there, but they export a fair amount of it. They don't include insurance premium taxes, which are significant. They don't include a number of business taxes that just don't fit into their model. They don't take account of the retirement preference. And they're using data that, frankly, I understand why they're using it, is because there's no new data set, but they're using 1988 IRS data. And then they're just adjusting it based on current income data. So, I mean, they're adjusting for the fact that income has risen, but we've had major changes in federal and state tax codes since 1988, and they can't account for any of that. They're in a tough spot. There's not a good alternative data set that they've been able to come up with, but I would take that all with a pretty significant grain of salt, as they're excluding so much that matters.
Okay. I've had a number of colleagues and even constituents ask about this income tax plan, and you talked about this in briefly, but again, I'm from Alcorn County, Mississippi, and I listen slower than I talk, I guess. So tell me about the C corporations, how that there's been some talk about the pass-through entities to avoid corporate income tax. How does this, how will it cause corporations to change over being LLCs, and that this will cause us to lose a lot of revenue where we're expecting to get?
I want to make sure that I properly understand the question. I think you're asking if we would expect, if we had, say, no individual income tax or a very low one that was lower than the corporate rate, would we see a change in entity formation from pass-through to, from C corporation to pass-through? Probably a very, very minute effect, because those decisions are made for much broader reasons than just Mississippi. They're made because of the exposure to to international taxes, to federal taxes, to state taxes in other states. It's a choice of formation that matters for how you are governed as a company. And also, most states have moved to what's called single sales factor for their corporate income taxes, where the only way that income is apportioned to the state to be taxed is based on the sales into the state, not the payroll property. Mississippi uses multiple apportionment formulas. Manufacturers use a 3-factor approach. I think it's double weighted sales if they're manufacturing for retail. There's some complexity to it, but to a significant degree, the amount of corporate net income that is subject to a particular state's corporate income tax is based on the sales into the state, not the economic investment or activity in the state. That's sort of a change over the last couple of decades as states have shifted in that direction. So it would seem unlikely to me that you would have much reason why companies would change their entity formation. That doesn't mean that they don't want like lower corporate income taxes too, and corporate income taxes have a significant impact on overall capital accumulation. But changing, especially if you're a company that's operating in multiple states or across the country, changing your entity formation is pretty unlikely. And again, 97% of your businesses are already pass-throughs, and most of the income associated with the 3% that aren't, that's going to be multi-state, if not multinationals. There are very small C corporations, and it's possible some of those change, but that's not a major source of revenue.
Also, is it fair to say that the federal tax disadvantages of switching from being a C corp to a pass-through outweigh the advantages of being a pass-through for Mississippi tax purposes?
Every business has a different model of what that is, but it's probably not going to be decided based on what you do here.
Again, I want to talk more about these targeted business input tax increases. Would it be fair to say that the tax foundation is happy with our plan so long as we remove these targeted business input tax increases like manufacturing and farming and logging equipment?
Well, sir, we neither endorse or oppose legislation.
That's fair enough.
We do
Fair
think
enough.
it's a good policy to remove those.
Would you agree with me that the House plans, the economic benefits far outweigh any negative effects?
We obviously had critiqued the House plan as introduced, and I think that I've been very pleased with what I've seen about the approach of focusing on paying for this with sales tax rate increase and then using phase reductions subject to triggers. I think there could be a very good design in doing that. I do think that it makes sense to think a little about the top marginal rate. Maybe you can take the rate down at the same time that you're bringing the exemptions up. There are other things that can be worth discussing, but it's very important to make sure the pay-fors are right, and also that the phase-ins, any triggers are designed in a way that provide the revenue stability. And we'd be happy to provide the committee or with any member with some things we've written on the design of triggers, because you want to make sure that any continued phase down, which would be part of this, is done in a manner that ensures that you have the adequate revenues as you're going. Some states have poorly designed triggers in ways that take, for instance, a 1 year dip or a 1 year spike, and they use that as a baseline. And I think that's a risk on the high side right now, where you probably have some revenues that are not sustainable. The last year's revenues are high, and they're probably not a great baseline. The flip side of that is that sometimes triggers are based year to year, and you get a state that maybe you experience recession, and when you're growing out of it, you're not actually growing, but you grew by a certain percent out of the trough, and therefore that triggers a cut. That obviously doesn't work. So designing to make sure that you're actually seeing stable, real revenue growth over time that is adequate to pay down the rate reductions. I think there's very responsible ways to approach that.
Representative Lamar.
Thank you, Senator. I'm gonna try not to be quite as long-winded. I know it's after lunch, people are getting tired. But you said something at the very beginning of your talk that I think everybody's kind of glossed over because we were still coming in, and I wanted you to comment more on it. But what I wrote down was that you mentioned that, talked about the rate of growth in non-income tax states compared to income tax states. Could you say that again to make sure we hear what you said?
Yes, sir. Population growth in the United States without a wage income tax has been twice the rate of states with a wage income tax.
Okay, now, I'm not here to tell you, and you're not saying that the non-income tax is the panacea. In other words, that if Mississippi does this, it's the greatest thing and it's the only thing, correct?
No.
I mean, you've already testified there are other factors that go in. We can't, New York City is New York City. We don't have that in Mississippi, right? Some people want to go there. It doesn't matter if the tax rate was 50%, they'd still want to go there. We can't replicate that here in Mississippi, but the ability to implement tax policy and eliminate our income tax is a tool that we as a legislative body have, correct?
Yes, sir. That's an option.
So as I understand what you're saying, look, you can't make Mississippi New York City or California, and we wouldn't want to be New York City or California, by the way.
I wouldn't think you would.
But you can make a difference with your tax policy. And it's not the only answer, but it is an answer that will improve things. Is that what you're saying?
Yes, sir. Absolutely.
All right. I know you're not an expert on the Memphis metropolitan area and or DeSoto County, but you are an expert on the trends of population moving in and out of different states, right?
Yes, sir. I can speak to that.
Okay. So if someone, and there was, I think Representative Johnson spoke about this earlier, but I think he was alluding to maybe some type of article that was written sometime in the last month. And so my point is, would it be wrong to assume that the population growth in DeSoto County strictly came from people moving there from Tennessee? That would be an erroneous assumption, right?
It would not. It would certainly be not the only interpretation. I don't know where they
Yeah.
came from. I'll be honest.
I understand, but people would move to DeSoto County because of its proximity to being to a major metropolitan area and the economic opportunities that exist in that type of an area, right?
Certainly.
Okay, and I'm here to tell you that, the Mississippi Delta has lost 100,000 or so, maybe plus people in the last 20 years. And as somebody who lives right on the verge of DeSoto County, a lot of those people that we lost in our Delta ended up in DeSoto County. And so a lot of DeSoto County's growth is not all Tennessee. A lot of it is people relocating there because of the economic opportunities from other parts of Mississippi.
And I would add, sir, that while this is not a question I have an answer to at this moment, this is a completely answerable question because the IRS has migration data and it's county by county. So you can actually see where people came from when they went to those counties.
That's great. I'd love to get that information, and I appreciate you letting me know that. That's why I asked you the question. I knew you would know something about it. Do you consider, or does the Tax Foundation consider the state of Tennessee to be a regressive tax structure?
I think that they have, as most states do, they have a tax structure that is probably right on the cusp between neutral and regressive. Some states have very progressive tax systems. A lot of states are roughly in the neutral area. So something that was mentioned earlier, the sales tax. I wanted to talk about why a sales tax is regressive, but also what you can do about that. Sales tax is regressive for two different reasons. And one of them has been clearly addressed here, and that is the lower income individuals will consume more of their income. They have to, and therefore more will be subject to sales tax. Two, though, is the base that you set, the things you include in the sales tax. And historically, a lot of states have taxed most goods and very few personal services. Now, we've talked about the business inputs, the business services, but as our economy changes and there are more personal services being consumed, individuals at the higher end of the income spectrum are consuming an awful lot of them. And sometimes they're untaxed. I mean, you were the first state to have a sales tax in the modern era in 1930, and yours was a goods-based sales tax, and it's remained very much that. There's opportunities to address the regressivity that is inherent in a sales tax, at least partially, by doing that. And then there are other aspects of the tax code that offset. The property tax system in Tennessee, I think, helps offset. That's not always true in every property tax, but I think it helps offset and makes it a much more neutral tax code.
Okay, so the answer to my question is that Tennessee has a neutral tax code.
I think it's fairly close to neutral. The important thing here too, though, is that we exist not only with taxes, but we exist in a tax and transfer system. Every state is also transferring to, using tax revenue for a lot of lower income individuals. And every state exists in an ecosystem that includes the federal government with a highly progressive tax and a highly federal transfer system. Most state taxes, so if you looked at ITEPs who pays, they'd say almost everyone's regressive. I don't think that's right. I think that's based on data with significant limitations. But I wouldn't tell you that most states are progressive either. I think that a lot of them are either mildly regressive or fairly neutral, but they exist in an environment where the revenue is being spent on something that is very progressive, and they exist in an environment with the federal government. And you compare this to, say, Europe. I shouldn't say all, the vast majority of European taxes are more regressive than US taxes if you're just looking at the tax picture, even though they're very progressive because they're spending it. They're spending it on these benefits. And I think that the whole picture matters.
I'd like to go to Europe one day, but I want to steer you back to Tennessee. Okay. So the answer to the question was that the state of Tennessee has a essentially neutral tax code. And if the state of Mississippi were to eliminate our individual income tax the way that has been proposed, and if we increased our sales tax to 9.5, which is virtually identical, it's actually slightly less than what Tennessee is.
Yes, sir. I think it would be fairly similar to where Tennessee is on this then, sir. And obviously the overall tax and transfer system would remain very progressive.
So based on that, then your opinion would be, if we did that, that would be as you said, approximately neutral tax policy.
I want to make a distinction. I'm not saying neutral from A to B. I'm saying that the overall tax code.
I understand.
Yeah. The overall tax code would be fairly close to that. And obviously the tax and transfer system would be progressive. But again, most state tax codes are in that mildly regressive to neutral range. They're usually not, with the exception of a few states, progressive.
I want to steer you back to the question that I started off with. Is it your testimony here today that non-income tax states population is growing at a rate double of income tax states?
Yes, sir.
And you've got data to back that up?
We have that. Yes, sir. We can provide that for you. And I believe actually that organizations here have written about that too.
Are you aware that the state of Mississippi is one of 3 states that lost population in the country in this latest census?
I understand that it's a loser. I mean, it's West Virginia, Mississippi, and I can't remember.
So maybe it's just 2.
There probably is a third, sir.
So if the state of Mississippi, policy-wise, us as policymakers, wanted to do something about that, a good thing we could do, because it's in our tool belt, would be to go to implement a policy making us become a non-income tax state. Seems to indicate that would help us. The numbers dictate that that would help us in the area of population growth.
I believe there's real opportunity with a more competitive tax code that can include either a lower income tax or no income tax. Pay-fors matter, revenue matters, but yes, sir, I believe that there's real opportunity and also real need because you are in a situation where there's not really great prospects of economic growth, where there's not in-migration right now, and that needs to be reversed.
Is that a yes?
Yes, sir, it is.
Okay, thank you.
All right, I think Senator Parker's got one last question and we'll let you go.
Thank you.
Thank you, Mr. Chairman. I didn't have any questions, but since a county that I'm very familiar with has been mentioned over and over, I feel like I need to at least supply some input here. In my role in the county, I'm fortunate each week to meet and see a whole lot of the new people who are moving to the county. We have a location that I practice in where they come in and we talk and they tell me why they're there. And it'll surprise you to hear that from Tennessee, a large number of the people moving into Mississippi tell me they're moving to Mississippi to lower their taxes. The taxes they tell me they're moving here to lower are their property and other taxes. And so are you familiar with cities like Chicago, Illinois and Cook County, Illinois that have an extremely high local tax rate and basically the urban flight away from that area?
Certainly, sir. I think that Cook County, Illinois has high taxes in every measure, not just the property tax, but yes, sir.
And would you be surprised to hear that DeSoto County has not had a millage increase in over 20 years and perhaps has one of the lowest property tax rates of any of the counties around the state?
I would say that's great, sir. Yeah, I didn't know that, so thank you for letting me know. And certainly, there are going to be jurisdictions that have very low property taxes, that have other low taxes that can be very attractive within a lot of different states. I don't think that changes a fundamental question of whether there can be a more competitive way for the state to raise its own revenue.
And I'll go back to this. You said earlier that Florida and California, other states, New York, are very good at attracting people into their state that have higher incomes, that are higher wage earners. Is there ever a disproportionate mechanism that's created when you lower the state income tax where you would perhaps attract someone to the state who wanted to come to the state maybe to rent instead of to own? Because what I see in my area is that the vast majority of people who move into DeSoto County come in and either build a house or move into an existing house. So we do not have a huge influx of people who I consider to be kind of transient, in their travel patterns. The people we see who come to DeSoto County, and by the way, for your reference, since you're learning about DeSoto County, from 1990 to 2010, Olive Branch, Mississippi was the fastest growing city in the United States of America by percentage increase. And we've also had a large increase, not in just the people coming in, but in the median income level and other things that we're very, very proud of. And so, again, I just want to bring this up to discussion because with all due respect to Chairman Lamar, I think the vast majority of people I see that are moving into DeSoto County, as I see it, are coming from the Tennessee area. And so are there ever any metrics or data that you look at where you could discourage a higher median income in the state by changing law in a certain way? I know you have a puzzled look on your face, but I think our county has been puzzling you the entire time.
I hope not.
And so if you're going to come and talk about Mississippi and the one county in our state that had a large number of growth when our state went down in population was DeSoto County, I would expect you to know at least a little bit about our county if we're going to be the topic of discussion during a hearing that's so important on this matter.
Well, thank you, sir, and I appreciate that. Obviously you do always have areas in states that are faster growing. And I think more metropolitan areas are growing faster across the country. Sometimes they're attracting from elsewhere in the state. They may also be attracting from other states. I'm not trying to, to try to diminish that in any way. What I was trying to figure out in that question is you were asking, I think, if tax policies under consideration here or other tax policies would potentially attract individuals who were at certain income levels, like lower income levels or more transient. And what I think we see as the experience of states with lower income taxes is that this does lead to relocations of individuals who want to make a life there. Obviously, states attract people in a lot of different ways. North Dakota attracts a lot of transient people because they come make their fortune and leave. But states that, generally speaking, are looking for ways to attract people, they're looking at that longer time horizon. You look at a state like Texas, you look at a lot of the states that have low income taxes or no income tax, they're seeing sustainable net in-migration. They're seeing people who are setting down roots there, who are not only buying houses, but building businesses. So I don't know that that's answering your question, sir. I'm not sure if I, maybe fully appreciated the question. I do certainly appreciate that, DeSoto County is doing very well. But I don't think that changes the overall question of whether there's ways that the state itself can generate revenue in a more effective manner.
Yeah, okay. Thank you for your time. And I know you've got to get going. So I appreciate you being here and offering your testimony. And if anyone would like to reconnect with Jared, we'll have his contact information available if you have any additional questions or anything. So thank you for your time and thank you for your presentation.
Thank you.
Our next presenter is Mr. Joe Bishop Henchman, the National Taxpayer Union. We'll take a 5 minutes. We're going to we'll let him get set up. We're going to take a quick 5-minute break and we'll get started back in 5 minutes. Look at you. All right. We will get the next presenter up. Mr. Joe Bishop Henchman with the National Taxpayer Union. Thank you for being here, and the floor is yours.
Thank you, senators and representatives. Good afternoon. Thank you for the opportunity to participate today. My organization, National Taxpayers Union, works to show Americans how taxes, spending, and regulations affect them. And while I'm based in Washington, D.C., I spend most of my time in the states, analyzing tax policy and working on tax reforms. And in the course of my career, I've testified in 36 states and advised on tax reforms in North Carolina, New York, Indiana, Iowa, Rhode Island, Louisiana, DC, among other states. And I should note my very first state testimony of my career was in April 2008 to Governor Barber's Tax Reform Commission. So it's good to be back in Jackson. I'd like to share 5 major points with you that I think may be helpful to keep in mind as you undertake this process. And then after that, of course, I'm happy to take your questions both today and in the future going forward. First, structure matters. It is very easy when talking about taxes to reduce it to a discussion of dollars. How much is withheld from your paycheck? How much is the check that you write to the government? And probably to the spending committees, a dollar may just be a dollar. But a dollar can be raised very different ways in taxes. Some taxes, a dollar raised requires very little administrative costs by the government, very little compliance burden by the taxpayer, and very little economic harm to the broader economy. While some taxes require a lot of administrative burden and a lot of compliance costs to collect that dollar. I raise this because a dollar raised from a poorly designed, complicated, narrow-based tax takes more than a dollar out of the economy. The time of the small business person figuring out how to pay it, rather than time they spend running their business. Economists call this deadweight loss. What people would have done with their time otherwise, and it's an overall harm to the economy because that's just lost. It's time by the revenue agency writing rules and lots of people reading them and suggesting changes to them, and then the time spent enforcing them. This is why different states will raise different amounts of revenue from similar rates of tax per person because of the tax base and because of the impact on the economy. It's also why many tax experts see value in tax reforms even when they don't lower overall revenue, because a well-designed tax reform will reduce those compliance costs, administrative costs, and deadweight loss to the economy, which will be beneficial to all. I do want to counter a myth that sometimes appears in the literature called the three-legged stool. It's often cited, this idea that you need multiple types of taxes in order to have a balanced, non-volatile tax system. It's not true. The literature bears out that it's not true. If you look at what states have the most stable tax system in the country, it's actually South Dakota, a state with no individual or corporate income tax. All they have is sales tax and property tax. But they're very well designed sales taxes and property taxes. There's very few exemptions. The rates are low, the bases are broad, and the money raised from them is relatively constant from year to year. The worst state in the country on volatility is my home state of California, which I can assure you has all 3 taxes, has more than that, has many taxes, but all narrow-based, high-rate, badly designed. And so they face a revenue situation where in some years revenue is up double digits, and then down double digits next year. So structure matters. Some people want tax changes to change the number of dollars, but structural changes to the tax system, if done right, can unlock more than $1. Second, every state is different. States have strengths and weaknesses, and I recognize this. If you were to put all of the testimonies I've given to all the different states over the years side by side, you'll find that the advice I give to different states is different. I am a tax policy expert, but I'm the first to admit that tax isn't everything. Lots of things affect individual and business location decisions. And I've got a very lengthy article in the Harvard Journal on Legislation, which goes into more detail on this, but suffice it to say, there's studies out there that see housing prices affect location decisions, education, cost of living, transportation, proximity of friends and family, weather, good food. There's even one study that found that where the CEO's spouse wants to live has a measurable impact on where the business ends up being located. So if all that stuff matters, why should you care about taxes? Well, a couple reasons. One, taxes can compensate for weaknesses and accentuate strengths. I know we've picked on California and New York a little bit, so I'm going to do that too. California has very high income tax, very high business tax, very high sales tax, kind of a middle property tax, but very high property rates. So let's call that a high property tax too. High taxes on everything. But certainly a lot of people willing to live in Silicon Valley. The success of Silicon Valley and the desire of many people to work there and live there or try to live there overcomes that punitive tax situation. California is successful not because of its high taxes, but despite them, although that may be changing now. But if you were to, and I know Jared said something very similar to this before me, but if you take the California tax system and you were to put it on Mississippi, you would not get Silicon Valley, you would devastate the economy. Different states have different strengths and weaknesses. Another reason is that tax policy is entirely within your control. Somebody may come up with an amazing education reform plan for the state of Mississippi, and you could pass it. And if it is amazing, maybe you should pass it, but you would have to wait a generation to see the full effects of it on the economic growth. Tax policy, for good or for bad, can be much faster in the impact that it has on the economy and on economic growth. Tax reform, also done right, can move the conversation beyond just how do we cut up the pie to how do we grow the pie for everyone. Because by boosting economic growth, you can increase the resources out there. And I mean, of all presidents, it was John F. Kennedy that promoted that idea in the 1960s. So what I advise states is think about your strengths and your weaknesses and how tax policy can play on that, can build on that. Third, the status quo is the status quo for a reason. When DC, the District of Columbia, was studying how to reform its local taxes to be more competitive and equitable, the study staff looked at kind of everything you could look at, and there was an interesting conclusion they found about the status quo. They realized that if you just look at every type of business under the DC tax code, the best thing to be was a nonprofit organization, because you didn't pay business taxes, you often didn't collect sales taxes, many didn't even pay property taxes. It's a great deal to be a nonprofit in DC. They didn't set out to do it, but it's also not a coincidence that that happened and that many nonprofit organizations have clustered in DC to take advantage of that. In Nebraska, another state that is considering significant tax reform, the agricultural sector there pays very little in taxes. And to make up for that, the state has to have high income business taxes. And to compensate for high income and business taxes, in order to attract large businesses, the state hands out major tax incentives to some very large employers. So Nebraska today has a successful agricultural sector. They have a handful of successful Fortune 500 companies, and everything else in the economy is struggling. That's not a coincidence. Ag does not want to change that in Nebraska. The companies receiving the incentives in Nebraska don't want to change that. And the people that would benefit the most from change are the ones who aren't yet living in Nebraska. They're living in another state, kept out by an uncompetitive tax system for them and for what they want to do, for what the opportunities they want to work in, for the businesses they want to start and build. If there was more opportunity, or the people looking to build a business were at the negotiating table, I think it would be very different. And Nebraska's keeping that in mind as they discuss that. Fourth, competition is real. In some ways, it's a really bad time to be a senator or a representative, because in the past, even a bad state revenue system could survive, because most sales happened inside the state. Most income was earned by people who lived and worked in the state, and most business activity was by in-state companies selling to in-state buyers. So a tax system in the past didn't really matter all that much for interstate competition. No more. A session or two ago, you had to update your sales tax to account for online sales. It's just the beginning. In recent years, we've seen investment and capital become so mobile that states and countries that you would never think would start reducing taxes on capital investment and income have begun doing so. France had to reverse and reduce some of its rates. This is happening a lot more. And in the coming years, I'm not the first to predict that we're going to see a lot more remote work than we did before. People are realizing that while they once thought they had to be at a desk in a tower in Midtown Manhattan or a corporate campus in Silicon Valley to do their job, they can do it from anywhere. This is bad news for California and for New York, but presents an opportunity for other states like Mississippi, with low housing and land costs, best cost of living in the nation. So while you can't count on keeping workers, consumers, and investors in the state, neither can anyone else. And states are getting very creative on this. My next stop after Mississippi is to Vermont, which is actively launching a program to attract telecommuters to move to and live in Vermont. They're asking, as many states are asking, what makes our state stand out as the place where people want to live and to work? Related to this, I know income tax is a big part of the conversation here. Important thing to know, you all know this, every business owner knows this, but I think the vast majority of people don't know this, is that much of the income tax is paid by small business owners. It's a quirk of the American tax system. It's not the case in other countries, but we have our partnerships and LLCs and our S corporations. Anywhere else in the world, they'd be paying under the corporate income tax. In the United States, they pay under the individual income tax. So when somebody talks about eliminating the top income tax rate, yes, most voters think of Paris Hilton or Donald Trump, but what they should be thinking of is, excuse me, small business owners. So these discussions, like the excuse me, discussions like the ones you're having, are essential. Thank you. Pardon me. It's this clean air you have here. I tell a joke. It's not a joke, it's a true story. I went to London and was talking with, thank you, someone who runs a study abroad program in London. And they say, you know, when a new student arrives for the study abroad program, this is disgusting. They start coughing up black stuff when they first move to London because of all the air pollution there. But that's not the scariest part. The scariest part is after about 3 weeks, it stops because the body just adjusts somehow. So I need to adjust to Mississippi. The discussions that you're having, like starting today and ongoing, are important in figuring out how Mississippi can be the place people want to live and work. And because of the competitive environment now happening all over the world, it's an important discussion to have, because increasingly standing still means you're falling behind. Fifth, it can be done, and it can be done responsibly, and it can be done fairly. Mentioned the District of Columbia, which, as you may know, is the bluest jurisdiction in the country. And they decided that they wanted, for competitive reasons, to reduce their middle income tax brackets, to cut business taxes, broaden the sales tax, increase the EITC, and reduce the estate tax. So how they set out to do it is they broke it into 26 pieces. They enacted 9 immediately, and then the other 17 in ordered stages triggered by revenue growth over coming years. So if projected revenue was above a certain amount, the next couple of steps kicked in. So they passed that in 2014, and it was fully in effect from January 1, 2018 onwards. That's when the last of those 26 pieces came into effect, because revenue growth was strong. So that's one way of doing it. North Carolina, before 2013, had a great tax system for manufacturers, but struggled with the rest of its economy. So in 2013, they decided to pare back tax incentives, cut the income tax significantly from 7 3/4 to 5.8, and reduce the number of brackets to a flat tax, cut their business taxes, and broaden the sales tax. They've since cut their income tax even further to 5 1/4. The special interests were heard, but there was also a determination to transform the tax system, a desire to do that. So they set aside a certain amount of money in the budget for reduced revenue, phased in all the other changes over 2 years, and kind of have this informal commitment in the legislature to keep state spending growth to 2% a year after that, which creates fiscal room for further reductions, which they've continued to do over the next couple of years, up to and including this year, where they may end up eliminating their corporate income tax completely after phasing it down significantly. Louisiana, on the ballot in October, has a proposal to cut their income tax as part of a fundamental reform from 6% to 4 1/4%, paid for by eliminating a very complicated federal deduction from a deduction of federal taxes paid on state taxes that they currently have. It's a very generous deduction, but nobody understands it, and it makes it very hard to explain it to out-of-state people considering investing in Louisiana. It also makes the sticker rate higher than it otherwise would be. So we'll see what the Louisiana voters decide on that in October. I was asked to talk a bit about Kansas. Let me just mention that, because it's not all roses. So Kansas in 2012 passed a bill. There's a lot more I could say than just those couple of words, but let's just leave it there for now. Passed a bill that cut taxes by $700 million a year off a $6 billion general fund budget, but only cut spending $150 million. And they had about $1 billion in reserves and the rainy day fund reserves when they started this. But the tax reform involved no structural reform. And it was most of the reductions were from elimination of taxes on pass-through businesses. So they passed that in 2012. By 2015, the reserves were down to 0. 2016, they raised the sales tax, but it wasn't enough. In 2017, they had to repeal the whole thing and kind of go back to where they started. I was very critical of Kansas from the beginning. I thought that they didn't really have a game plan on what they were going to do. And really, that's the lesson of Kansas is to keep that in mind. I know right now it's very difficult to know, not just in the world of tax, but in the world of everything, what's one time and what's recurring, what's likely to continue and what's already done. But states do have ways to be bold without being reckless. Indiana is another example. They're a state that has set out to chip away at their income and corporate taxes every year. So 2011, their corporate tax was 8.5%. They've chipped it down to 5.25% just by doing a little bit every 2 years. So the states that I've mentioned, they all have something in common. They're not really any of the states that were mentioned earlier throughout the day. They're not the economic powerhouse states like New York or California. They're not some of the more struggling states. They're states that want to be competitive, that want to get in the game and recognize that the tax system is part of getting involved in that. And the trends that I'm seeing in the states that are moving forward on this, and this year has been a blockbuster one for states doing stuff with their tax system. 11 states have cut taxes this year or done significant tax reforms. I think a lot of that was using the cushion of the federal revenues and everything that's going on in order to be able to push along on some big decisions. But generally what I'm seeing is a shift away from business taxation and income taxation to some extent, which are all both highly mobile, towards consumption taxes, a shift away from incentive-heavy tax systems to broad-based reforms designed to benefit everybody, and a willingness to have these discussions in a way that we haven't really seen before because of the competitive pressures that every individual business and state are increasingly under. So those are the 5 points I wanted to lay out. Structure matters. Every state is different. Status quo is the status quo for a reason. Competition is real, and it can be done responsibly and fairly. And with that, happy to take any questions you may have.
Any questions? Senator Horn, you're up first.
Thank you, Mr. Chairman. Mr. Bishop Henchman, judging from your name, I wonder if you say a prayer over an individual before you hang them. That's meant to be a joke. So you made several great points. All states have strengths and weaknesses. How we cut up the pie versus how we grow the pie is what's important. And you mentioned that Mississippi currently has the best cost of living conditions as far as the cost of food, housing, etc. And you have a history of some knowledge about this state, having worked with Governor Barber and his administration. Do you believe that changing our tax code to lower or eliminate the income tax and raise retail taxes on sales is the best way for Mississippi to go in order to grow our economy?
Depending on how it's done, I think it can be, that kind of change could be very dramatic in a good way, in drawing attention to the state and compensating for some of the weaknesses. I don't know as much as everybody else in this room does on why the people who move out of Mississippi, why they're moving out, and why the people who stay in Mississippi are staying. What I hear a lot, just in a handful of people that I talk to, is a lot of people move out of the state because of lack of job opportunities. And a lot of people who stay in the state do so because of cost of living and family and friends and a lot of really good factors. So how do you get the people who care about cost of living, who right now are looking for where they want to move, to consider Mississippi? And how do you get people who are looking to build a business, small or large, to include Mississippi in what they look at? And I think there are some strengths there that Mississippi already has, but obviously if cost of living was all that mattered to individual and business location decisions, we probably wouldn't even be here talking. It's not enough. There needs to be something more, and a significant and dramatic tax change could be what draws attention to that. Now, I did have a caveat of depending on how it was done. I mean, you don't want to do it the way Kansas did it because that wasn't sustainable. You want to do it in a way that can be maintained.
And you talked about chipping away that some states have done, and then some massive wholesale change that other states have done. Which schools of thought do you advocate?
Well, that's a very good question, and a lot of it comes down to the character of the state and the situation that they're facing. So, for example, Georgia has a AAA credit rating, and they really like having a AAA credit rating. And every meeting you'll have with the governor or the elected official, they will find a way to mention that they have a AAA credit rating. And that's a good thing to have. But it got so much of a pride point that for a long while they were uncomfortable considering any changes to anything out of a worry that it might jeopardize the AAA credit rating. They were one of the 11 states this year that made significant tax cuts, I think, because the availability of revenue this year allowed them to kind of get past that mental block of, oh, is this going to hurt our AAA credit rating if we cut the income tax by 0.1%? So for them, it's just the character of the state maybe suggests that maybe something a little slower is really all that you could potentially do in a state. State like North Carolina, and to some extent DC, they didn't go slow. DC, I guess, was over a couple of years. North Carolina was rather immediate. And I think a lot of that was anxiety over wanting to get moving and get the economy going and start getting people in and stopping the outward migration. And so that, if that's more of the concern, then you can see a state being a little bit bolder.
And one final question. You mentioned, I've forgotten which state, maybe Nebraska. States are taking advantage of telecommuters, of being able to do a job from practically anywhere. If you were advising Mississippi on ways that it might get into that game, what would be some of the things we would need to do in terms of our tax code to make us more attractive?
Well, obviously the income tax is a big part of that. For somebody working in Silicon Valley or Midtown Manhattan, as been mentioned earlier today, they're paying very high income tax. And so that delta, that difference between what they would pay there and what they pay here can be considerable. But generally, I'd say, talk to them, find a way to reach them and sell them on the high points of Mississippi. The income tax maybe starts the conversation, and then you can fill in the rest of it with all the other selling points of the state. That's something Nebraska's had to do. If you're corporate recruiters in Omaha, it's not been enough to because of all the hindrances they face to just try to recruit people. What they found they had to do is fly people into Omaha for a weekend, and so they can, with their families, and they can kind of see themselves living there, and they find that to be the best recruiting tool. And that's for high income jobs in the Fortune 500 companies they have in Omaha.
Thank you, Mr. Chairman.
I've been to Omaha recently and it was quite a wonderful event, but anyway. Are there any other questions from any of the committee members? One of the things you had mentioned, the 11 states that cut taxes this year. Do you have a list of those, or do you have kind of what state and what tax they cut?
I can provide that to you.
Okay. Yeah. And then I guess talk to me about, you said these states that are doing these tax cuts are overall overhauling their tax system or broadening the base. Can you speak to that and what that means? I mean, I guess as comparatively speaking, how many services are we taxing? How many are like Texas or South Dakota or any of these other states? How broad is the base, so to speak? I guess, could you speak to that?
Yeah. I think I think most people get it, but maybe don't get it, that the sales tax doesn't apply to everything that you buy. I think you all know this. You're all familiar with the tax code. But most sales are not subject to the sales tax, and your average sales tax in the United States, state sales tax, only applies to about 40% of transactions by dollar amount. I think Mississippi is a little bit higher, primarily because of the inclusion of groceries in the sales tax base, which, as was discussed earlier, is about equivalent to a point on the sales tax rate. But most states exempt services, most states exempt groceries, most states carve out a lot of things so that only 40% is left, which means the rate on what you do tax has to be all that much higher. I did mention South Dakota as a state with a very stable tax system, even though all they have is property tax and sales tax. They do tax services. And why this matters is services is a much larger growing share of the economy than goods historically has been. But it's a reason why you can't exactly compare state sales taxes purely on rate, because different states will have the different bases of what they do subject to tax, and that necessarily results in different capacity of what the revenue you can raise from it is.
Comparatively speaking, Mississippi versus other states, do we tax a number of more services, or are we lower than most? Where do we rank in the scheme of how many services does our state tax versus other states?
Lower than most.
We're lower than most?
Yeah.
Okay. All right. Was that? Yeah. All right. Well, are there any other questions from any of the committee members? Representative White.
Thank you, Mr. Chairman. Thank you for being here. The House plan, and maybe it's been on trial here today and maybe it hadn't been, but we were eliminating the income tax as quickly as possible. And we had raised the sales tax in the bill that ultimately passed the House with some nuances in there. What is your position, or what do you say, or what do I say to the guy who says, no, you just need to get rid of the income tax. You can't broaden the base. You can't tax some other services. You can't create a new tax. You can't raise the sales tax. But when we run the numbers and we get Elbow to run those numbers, we're looking at 30 years, 25 years, 30 years, 35 years in some scenarios to get there through some strict everything over 2% growth or 1.5% growth, and not putting forward maybe some conservative arguments that I would make about government spending that we should cap anyway. Forget that. If we're trying to maybe level fund and be responsible policymakers about our state budget, what do I say to the guy who says, you can get rid of the income tax, and that's a great thing to do, but don't raise any other sales tax. Don't broaden the base and tax some services. What do I say to that guy?
No, it's a very good question. I'd make 2 points. First, this isn't Washington, D.C., and we can't just deficit spend and kind of wave that into the future. The Constitution requires, the Mississippi Constitution, that you balance the budget. And you take that seriously. And even if you didn't take it seriously, you have to do it as a legal condition. So being able to truthfully say that this is going to not create a deficit situation in future years, it's an obligation and a responsibility of being a representative and good stewardship for the taxpayers in the state. The second point I would make is what fiscal experts talk about all the time is broad bases and low rates. And it's a way of describing equity in the tax code. Because when you don't have broad bases and low rates, what you have is a system where some people are paying a lot and some people are paying not much at all. And it doesn't even fall cleanly in the way that a lot of people think it does. You will have people in a quote unquote poorly designed tax system where rich people are earning a lot but paying nothing, and low-income people are not earning a lot, but paying a lot relative to the income that they earn. And good tax reform should be keeping that in mind as well, and trying to adjust for that. And, so I'm a lawyer, and if I write a will for somebody in Washington, D.C. and charge money for it, I have to collect sales tax on it now, just like the person who owns the 7-Eleven has to collect sales tax on everything they sell. A lot of lawyers were not happy when that change was made, because they viewed it as a tax increase. But what it really was bringing about equity in the tax system. That's what worked for DC. What works for Mississippi, maybe it's something different. But I find talking about fiscal responsibility and equity can sometimes break through with some people.
But is it doable if you're not broadening the base, or if you're not raising a sales tax, or you're not broadening the base, or hitting new services? I understand we can broaden the base
Right.
and hit attorneys. I'm an attorney. I shouldn't be asking this question because I don't know what you're going to say, and attorneys aren't supposed to ask questions when they don't know what their person's going to say. But we're running into this idea of, oh, just phase it out, even if it takes 40 years. That's the thing to do. Don't hit a new tax over here, or don't do that. And I truly think that everybody around these two tables here is trying to be responsible and do it the right way and not reckless. And we don't want to be Kansas. We don't want to go down that road. We want to do something different. Senator Brown and I agree 100% on that. And we don't agree 100% on much of anything, but we do on that. And so is there, I mean, are we headed down the wrong road in looking at broadening our base, or looking at the sales tax and surrounding states and how they tax?
So if you want to cut a rate while still raising the same amount of revenue, I mean, you have 4 options that I'm aware of, at least. You can raise rates on something else, you can broaden the base, you can grow the economy, or you can borrow, or, a combination of any of the 4. So those are your options as far as I'm aware of. What Kansas did was they understood those were the 4 options, and they chose to move ahead anyways to see what would happen. So they ran an experiment that now we know the results of that experiment. You don't need to run that experiment to know how that turns out.
Senator Parker. Senator Bryan, you're up next.
Thank you, Mr. Chairman. Thank you again for being here today. And your talk has just gotten me thinking about something just a little bit different than I was thinking earlier, because at the beginning of our discussions today, we were given a handout by Department of Revenue that had some very nice maps in there. And there was one map on page 26 that said how high are individual income tax rates in your state. And he at that time made the comment that, it showed us at 5%, but that nothing in that 5% number there was a weighted average that took into account deductions or other things like that determined what the true tax rate was, or took into account what Senator Harkins was talking about, the fact that we don't tax everything in the state equally to other ones. So, and per your discussion, I understand your concept that if you're going to do something in a slow pace or incremental pace, that sometimes might work better than what Kansas did. But I want to just mention this. So some of the discussion we've had has been that the way to start eliminating state income taxes was to kind of work our way up from the lowest marginal tax rates up towards the top one. So we would incrementally start looking at, okay, let's knock out the 3, then move up and just kind of work our way up.
Right.
If we did that, would our rank on this map right here, it really wouldn't change until we got to the goal line, would it? We would still be ranked at 5% at highest marginal tax rate. And the reason I'm asking this is, would anybody who's thinking about relocating or moving a business here be even aware that we had made that move? And I'll follow this with a second follow-up to that would be, just for discussion here, would it not be worth giving some consideration to kind of lowering that top % down at the beginning, or at least some portion, so that at least on this map, it looks like we now have a lower top marginal tax rate. If you understand the direction I'm going on that, would you
Yeah,
comment?
no, I'm familiar with the map, which is just top income tax rates. So that's all that it's looking at is that 5% top rate. And so you can do whatever you want to the rates below that, and your top income tax rate, if it's still 5%, that's what the map's going to show. And that's not even necessarily the wrong answer, because trying to do this without going into econ speak, the marginal, people make decisions based on what the tax they're going to pay will be on the next increment of activity that they do. So, I mean, let me use a lawyer example. You know, if I'm going to take on the next client and I've already done enough work in the year to put me into the top income tax rate, that top rate is the marginal tax rate I'm facing. Now, you may, at the end of the year, once you take all my deductions and divide everything out, it's really not 5%, it's 3-point-something%, but that's not how my mind works when I'm making the decision on whether to do it or not. It's not how a doctor's mind works when he thinks about taking on more clients versus spending more time on the golf course. It's not how a company thinks about these things when they're thinking about where to locate the next increment of business. The accountants will think that way, but it's in a backwards looking, it's not the people looking forward. So the marginal tax rate does matter, and the top sticker rate does matter. It's part psychological, but part a factor of economics.
And so, you think that might matter more to perhaps the business and industry types of decision makers, both in the state and outside of the state, as they're, quickly. And we had other reference today, and I talked to economic developers about this all the time. There was a reference made to if a company's considering the state, whether or not we even make the cut to be considered.
Right.
Because there are a lot of projects that we don't even know. We didn't, there was a map or something like that was viewed by someone, and we didn't even get to be considered about it. And so I'm hoping in whatever we do on this topic that we do make it easier for other people around the country to realize that this is a good place to relocate and to make that difference. So, I guess what I'm thinking is it might be worth considering trying to move that needle at the top a little bit, along with moving the needle at the bottom, instead of just working just all the way up the scale. So you can comment more on it, or we can move on to the next question. So.
Well, obviously, it's a big part of the discussions that you're all having of, I know some people want to move that to very dramatically to 0, and then that would be part of it as well.
Thank you, Senator Brown.
Well, there was a comment that I wanted to do it in the right way, and I wish to disassociate myself from any concept that I want to do it connected to the state tax code. There's no problem with the state tax code. It's about like every other state. We do have problems. Our roads are falling apart. We need a 6-lane highway going from the Gulf Coast to Madison. We've got problems with water and sewer all over the state. You see what's going on in Jackson, but there are communities in everyone's Senate district, in everyone's House district that also have problems with water and sewer. We have an opportunity to fix them. We need broadband everywhere. We need to quit getting our names in the paper for having the lowest vaccination rate in the nation and going down to the vets to get deworming medicine. Those are the problems that Mississippi has. Our problem is with our image, and our problem is with infrastructure. If we want to do something that's game changing that gets people's attention, fix all the water and sewer. And say Mississippi used to have this problem in Jackson. Not only did they fix Jackson, they fixed everybody else in the paper. Maybe that'd get in the national news. Broadband, we're making a great headway. We're very close to having true gigabyte broadband to every house in the state of Mississippi. If we did that, that would make an impact, and on and on and on. So I do not think that our tax code has much to do with anything connected with economic development or the future growth of the state. And if I did think that, Mr. Chairman, the last thing in the world I would want to do would be make any decisions about the tax code anytime in the next 2 or 3 years. We don't have a clue what's going on with the economy. We don't know if this boom is going to continue and we're going to be awash in money, or we're going to have some other letter of the Greek alphabet, since we've got the whole world sitting around being human petri dishes, breeding variants on this virus. We don't know what's going to happen. And so I would think the prudent thing to do about taxes would be, as long as money's coming in, let's take it, use it on long-term investments, use it on infrastructure, use it on things that'll be here 100 years after we're gone. And 2 or 3 years from now, whoever's here might be able to have a better idea of what the world's going to be like than we are. So I just, Mr. Chairman, want to disassociate myself with any notion that I'm trying to do it the right way. This ain't the it that I'm trying to do.
Representative White, did you want to try again to
I don't,
persuade?
I never meant to imply that Senator Bryan was for cutting anybody's taxes. So let me be clear about that. I don't know why he was appointed to this committee if he's not for that, but we can talk about that at a later date. But I'm glad to have his perspective. I always appreciate his opinions. I feel like they're well thought out, and he means what he's saying. Having said that, I do want to be sure we all acknowledge the fact that the House plan was nowhere near the Kansas plan with regards to responsibility, caution, and replacing revenue. So while Kansas tends to bleed into the discussion, it's been used in op-ed pieces recently in places like that. It certainly in no way resembled the plan that the House put forward. And it's certainly not.
If you're
our
about to
intention.
pass the Kansas plan, I will let you know.
And it's certainly not our intention to go down that road. And thank you.
However entertaining this exchange between Representative White and I may be, we probably need to move on. But I do want to point out that until this most recent tax cut, which I thought was irresponsible, I was the co-author of the largest tax cut in the history of the state of Mississippi. And I could explain why I thought it was a prudent time to have that tax cut and a prudent way to go about it. So you just weren't here when I was cutting all those taxes. You're so young.
He's a Republican. All right, Senator, Representative Lamar.
We're going to move on if we can. We've got an expert in front of us today that we don't often have, and I've got a question that I'd like to hear you answer. If I've missed what you said, and you've already answered it, then I apologize, but I don't know that you've answered this particular question. You have familiarized yourself with the proposal that the House passed last year. You've also heard the talk of another way of doing it, which would be, as you said, just chipping away at the income tax. My question to you is this: in which manner does the state of Mississippi and our people get the biggest bang for our buck? 2 examples: whether we just chip away at the income tax over the next 35 or 40 years, or whether we bring our sales tax up to match our surrounding states and decrease a large or eliminate a large portion of our individual income tax right out of the gate in year 1 to neutralize revenue, and then phase out the remainder in, say, 10 or 12 years, which is similar to what the House passed last year and what we've been discussing. Which one of those gives the state, which ones helps us grow the economy more? Which ones helps us to become more competitive? Which one helps grows our GDP more? All those factors that we look at. Where do we get the most bang for the buck?
I think ultimately that's a political question for the House and the Senate.
But my question is, I don't know that it is a political question, though.
Yeah.
I mean, to me, it's an economics question. I'm asking you which policy
If
decision.
you're asking me if
would help
you know,
us grow more.
Would Mississippi eliminating the income tax in the next 2 years be noticed? It would absolutely be noticed. And if it's done in a sustainable way that's passed, that's good. That's great.
I don't know that you answered my question.
I apologize. Can you try one more time?
Yeah, if the two proposals that we've looked at, phasing it out over the next 35 or 40 years, if that's how long it takes, a little bit at a time, or phasing out the first $1 billion of it or some semblance thereof in year one and raising our sales tax to where the revenue is neutral, and then phasing out the remainder over, say, about a 10-year period. One is we get rid of our income tax in 10 years. One is we get rid of our income tax 35 to 40 years from now.
Between those two options, obviously, moving more quickly would be more beneficial.
Okay, now you have answered my question.
I
Thank you.
apologize.
All right. Any other questions? Senator Johnson.
I think a while ago, I think a while ago you said that broadening the base was more stable. Is that how you said it for stable income, broaden the sales tax base?
It results in more stable tax revenue over time.
And
Because it's at that point, you're growing with the economy rather than picking and choosing pieces of the economy that may or may not be growing at the same rate as the economy.
have other states broadened their base in recent history, say the last 10 years? And if so, can you give me a few examples of who did that and what they may have added?
Sure. A number of states have added, and I can get you a more complete list. This will just be off the cuff, but a number of states have added personal services. And some states have considered more dramatic increases. None have succeeded in doing so to kind of throw everything in because, well, as an example, Nebraska had a proposal to apply the sales tax to everything. And at their first hearing on considering the bill, they had every lobbyist in Lincoln and probably some from other states who were there. And the script was the same. Each representative of each industry was, I support tax reform. I think we need to broaden the base to stick with the economy. My service is different, and here's why. And what would happen is they take a few things out, but then that would collapse the whole effort, because then it becomes, well, why do I have to be subject to it and you don't have to be subject to it? So there are several states that do tax everything. South Dakota, I've mentioned. New Mexico is another one. But they've always taxed everything from the initiation of their sales tax. So they didn't get this transition issue that I referenced earlier, where you're having to explain to people why they weren't collecting sales tax before, but now they might have to now. DC expanded to a number of business retail services. The most controversial one ended up being fitness memberships. They did a whole list of like 15 of them, but fitness memberships was really the only one where there was pushback on it, organized by that industry. But ultimately they predicted, all the gyms would close if we have to collect 6% sales tax on our memberships. And the council didn't listen, and they passed it anyways. And we have more gyms than ever. So.
Thank you.
All right. Seeing no further questions, Joe, thank you so much for being here. We appreciate your time and your testimony.
Thank you.
We're going to bring our state economist back up. I think some people had some questions for him real quick, and then we'll wrap today up. All right. Thank you, Corey, for coming back. And I'm going to open the floor back up. I know there were several people that had questions earlier. Yeah, okay. Do you have questions? Go ahead. What, Representative Lamar?
Thank you, Chairman, and thank you, Corey, for coming back up and sticking around all day. Appreciate your presentation this morning, and I had my mind around a few questions that I wanted to ask you, but I hadn't looked at it in a few hours, so bear with me.
Okay.
One thing I did want to ask you is your analysis of House Bill. I guess it would be the House bill.
Yes.
Did you talk about that this morning at all?
Not specifically, no.
Okay. But I just want to make sure, get you to talk about it if you would. Could you, I mean, your office did perform an analysis, correct?
We did, yes.
Okay. Could you just kind of hit the high points of what you found and your conclusion?
Basically, we found the House plan would be generally revenue neutral, maybe a little more than revenue neutral in most years by the way it's designed with triggers. And in terms of impacts on the economy, we found those to be all positive in terms of real GDP, employment. I've got a copy here. I'm going to reference it right quick. And population, but that they're also relatively small. And that's about as far as we went as far as that analysis.
Okay. So just to recap, you found that the plan is revenue neutral or slightly positive, I believe is the wording you used in your report. And then you found that the GDP would grow, and what else did you say?
Employment and population.
Okay. Are you familiar with, we're going to hear from them tomorrow, but there were two Ole Miss economics professors that did an analysis of that proposal as well. Did you get a chance to look at and study their proposal?
I have seen it. I don't think we're that far apart, actually.
Okay.
They have some bigger economic impacts from the House bill than we did in our analysis. That was kind of the main difference.
Okay. Do you have reason to disagree with what they found, or you found your reports were somewhat similar?
I think they're similar. Of course, you make different assumptions and you get different outcomes. Like I say, I didn't study it in depth. But like I say, other than they predicted larger economic impacts from the bill than our analysis did. That was really the only thing.
There was one thing I wanted to ask you, Corey, as well. You mentioned earlier, if I can look at my notes, you mentioned something, and maybe I'll just let you comment on it again, but about, and I want to make sure I heard you right, but I believe you said that government employment or income at the government level is greater than income from the private sector in the state of Mississippi. Is that what you said?
What I was trying to say is that the average income from a public sector worker in the state, I believe, is about $49,000, and the private sector, it's around $39,000. So that makes a difference if the state has to cut employees.
Okay.
Through.
It just seems to be backwards from everything I've heard in 10 years being in legislatures. We don't pay our people enough, and maybe we don't, but if we don't, then the private sector doesn't either.
Well, that's across everything. And
Okay.
that goes back to our issue of human capital in the state.
What would you say is our state economist? What is Mississippi's greatest impediment and or need, however you want to clarify that, for growth?
I think it's absolutely human capital.
Human
capital, that's normally we typically think of that as education and training. And that is part of it. And Mississippi's percent of our population that are high school graduates. That has improved, but it's still a little below the national average. We are well below the national average in terms of college graduates. And also human capital includes factors like health. Sick people can't work. Or can't work as much. And so that's a problem. We have a very high rate of disability. We have a high rate of obesity and diabetes and all sorts of other diseases. So I think that would be our biggest impediment to economic growth in the state.
Okay. You have just mentioned your study of the House proposal and stated that in your findings, that it grew GDP. We mentioned the Ole Miss professor's report, and their report found that, and they state this is a very conservative number, and they'll get a chance to explain their report tomorrow. But in their report, they state that at a bare minimum, the state's GDP would grow at approximately $375 million per year.
Our numbers were lower than that. I think the biggest year we had, we looked out about 12 years. I think the largest increase we had in GDP in 1 year was $62 million.
Okay. Regardless, though,
Yeah.
it was positive growth, correct?
Yes.
Because of the policy change. And the Ole Miss professor said the same thing. You just heard the national expert from the Tax Foundation who said that eliminating our income tax and even doing it in a 10-year manner as opposed to a 30 to 40-year manner would grow our state economy. And you're telling us that the greatest need for the state is human capital. Does human capital increase along with GDP increase and private sector growth? Are those two things that correlate together?
Human capital improvement should increase GDP. So it's kind of hard to measure human capital improvement in the short term. Our models really don't capture that.
Okay, well, I guess I'm not
If we
asking.
improve human capital, we will improve the GDP. Is what I'm trying to
And
say.
is the converse of that also true? In that if our GDP is growing, then our human capital should also increase.
Possibly, but not necessarily, I guess is the way I would say.
Well, explain that for me then.
There's lots of different factors that can increase GDP because it's a sum of output in the economy. Our GDP is going to increase this year because of several factors, because of all this federal money that has come into the state, because of we are coming off a decline last year. So growth this year is going to look better because of that. So you can have it, and you can also have improvements in human capital, but it's not really necessarily a one-to-one. I would argue it's not necessarily a one-to-one.
Sure, and I'm certainly not arguing that it is, but what I'm trying to get a better understanding of is there data that reflects that as GDP increases, human capital also increases? And I'm not saying it's one-to-one, but is there a correlation?
I'm not aware of data showing that. I mean, you'd have to see a improvement in productivity, and that causality is usually in the other direction. So
how much is out migration of our dollars? How much of that plays a problem in Mississippi's economy?
Out migration in what sense?
Well, if I need a widget and I go buy that widget, it's not offered in Mississippi. I have to go to Texas to buy it. Do you know how much out migration of dollars we have?
I really don't know the answer to that question.
Okay.
How much of what we spend ends up in other states? I really don't know that.
I've seen some data that Mississippi is a large proportion of our dollars leave the state. And so that it would make sense that if we are growing our private sector economy in the state of Mississippi, if our GDP is increasing, then more of our dollars would also stay here at home. Would you agree with that?
Agree with that, yes.
Okay. And so the real issue that I'm trying to understand more of is that if eliminating the income tax, which we've all agreed and the national experts have agreed, would increase our state's GDP and help grow our private sector, then at the same time, I'm being told that human capital would increase, needs to increase. I'm trying to figure out why wouldn't we do it? Every positive sign seems to point to this is something that we could do here today that would help the state of Mississippi. Do you have any objection to that?
Is that, do I have an objection to what?
To what I just said? To
What's
everything
the
that
question?
everything that we've just said is pointing toward eliminating the income tax, equating to positive growth, both in our economy, our GDP, human capital.
If you're asking me, are there reasons not to do it? I mean, I could probably, we haven't looked at the welfare impacts of that in terms of, are there people who are going to pay more in taxes because of increasing the sales tax and elimination of income tax? We haven't looked at that. So I can't answer that part of that question. I don't know.
Okay, but you stand by your report, correct?
I do.
Okay. And you don't have any major disagreements with the Ole Miss economics professor's report?
Not beyond what I've already said, no.
Thank you.
Any, Representative White, did you have a question or comment? Representative Johnson?
I'd given up on it, but it interests me. You said that I'll ask them tomorrow, but the Ole Miss professors projected it to be a $365 million thereabouts increase or impact, and yours is 62. That's like 40. I mean, it's 5 to 6 times less. What is the explanation of the difference?
Well, I think it has to do with, and you can ask them in what they assumed. But I think it's the assumptions that go into the model.
Well, one of the reasons I asked that question, because as I've studied and looked at this thing, just about all the economists and tell me if I'm wrong, if I'm reading this right, say that even though there may be some positive increase that is marginal, is that more consistent with what you find? There is a positive increase.
Yes, sir.
Is that pretty much what economists say?
Um,
There'd be a marginal
That's how I would characterize our analysis that way. Yes.
And I heard this question earlier, and I'm gonna ask it, it's in a different, for a different demographic, but Senator Polk asked about a retirement. But African Americans in this state and around the country make about 60% income-wise of what the majority population makes. Have you all looked at what the impact will be? Because I've been asked this question on the African American population in terms of this being regressive. If you raise sales tax in this state, of people of color who make less money on average.
We have not looked at that. No, sir.
And your explanation about the difference in income, state people who are public employees as opposed to the private sector. And I'm like Mr. Lamar. I've been told ever since I've been elected that the money, we can't hire people in the public sector because they make more money in the private sector. And you telling me on average, people make more money as in the public sector than they do in the private sector in Mississippi?
Yes.
And could that be because you mentioned some of the problems that we have in terms of healthcare? We have all these health outcomes. So we have a lot of medical professionals, a lot of people working in state hospitals or government-run hospitals. Could it be in the healthcare profession that we may be seeing a bump that way?
That could be part of it. Yes, sir. I don't know the breakdown of it exactly.
Okay. But no, you can't tell where else it may be, but your numbers are pretty.
It could be in school teachers. That could be part of it.
Well, the school teachers are adding to the bump. What we paying school teachers?
They could make more than, say, people in leisure and hospitality sector.
That's right.
Food services.
Private sector would include people in the service industry as well. Yeah. Okay. All right. Thank you. I appreciate that.
And with regard to why our results look like they did, I think the explanation is because it was generally revenue neutral. So the state is spending about the same amount it was. So the impact to our GDP is probably smaller than theirs for that reason. And I don't know exactly why the while we get a little bit of a bump, it's probably because maybe some of the higher income taxpayers benefit. That may give us some.
More importantly, though, back to the original idea is that positive, even if it's marginally positive, is revenue neutral. So we're giving people an opportunity to take more money home based on the house plan, without affecting the overall budget. We're still being able.
I would agree with that.
We won't
yes.
lose services and programs.
No, sir, I don't think so.
All right, thank you.
Representative White.
Thank you, Mr. Chairman. And certainly, if you made an analysis, as the gentleman from Adams maybe alluded to or requested, about how that affects minorities in the state by raising that sales tax, would it disproportionately? Any analysis there would certainly, I'm assuming, also include the cutting the grocery tax in half that they would receive in that same thing, because there is that aspect to it. It's not just a generic increase, as the House plan was presented and passed. That would be part of any analysis there, I guess.
It would
Just
not
want
be
to point that
Not
out.
be just a straight 2.5% increase. It would also have to factor that decrease.
Thank you.
Senator Horn.
Thank you, Mr. Chairman. Corey, would it be fair to say that your office probably studies the state's economy more than any other entity in the state?
I hope so. I hope that's right.
Have you ever been asked, okay, look, we want to grow this economy. We want to move Mississippi forward. Have you ever been asked to put a plan together to do that?
I have not. Probably our office in the past may have been asked that. My guess would be it probably has at some point, but we have not recently. We used to have the Planning Bureau several years ago, and I don't know that that really exists anymore other than on paper.
And let's say that you were asked to put a plan together based on your educated knowledge about the economy. Would you incorporate and factor in a lot of the underfunded or unfunded liabilities that the state may be facing?
I think you have to look at everything. And I'm not a policy maker, obviously. But I can look at the factors that limit Mississippi's economy and can point to how improving those factors would improve the overall state economy. Like I've already mentioned, our human capital and infrastructure.
So, we have a lot of strengths and weaknesses in Mississippi.
Yes.
But a lot of the weaknesses generally, this is just my opinion. If I were to ask what are the state's weaknesses, changing the tax code wouldn't be at the top of my list. I'll just say that if we're looking to grow our economy, if that's the reason we're going to amend the tax code, wouldn't you think that we would take a more holistic approach to solving all the problems of Mississippi as opposed to just focusing on one area?
I would say look at everything, and that's where I'll leave that.
Thank you. Thank you, Mr. Chairman.
No, I'm not asking. Corey, when we first, I guess, contacted you about this, you issued a report and then you issued a second one. What was the difference in the two reports? Because it seemed to be kind of a different narrative on the first report we did compared to the second report.
Talking about the two different analyses of the
Yeah.
House plan.
Of the House plan.
The first one was we were not trying to, because of the way our model works, our REMI model, and we never did get a good way to do this, was to capture those revenue triggers. And at first we were just looking at the overall change in revenue from the elimination of the tax, how much revenue be taken in and how much would be lost due to the elimination of the income tax. And we didn't really get it down to a particular year. Like I say, we didn't really find a way to do that in our REMI model. We went back and looked at it on a year-by-year basis, and that's the way we did it in our second report, which is show each year one at a time. That was more done in an Excel model that was able to capture that. That was basically the difference.
Okay.
Look at it and trying to look at it in the overall time period as opposed to year by year. That was kind of the way we changed it.
So by looking at it year by year, you got a different result than looking at it overall.
I don't think it's really that much of a different result. I think it was largely revenue neutral, a little more than that, both ways we looked at it. It just wasn't. The first way we're doing it without the triggers was you might have one year that wasn't positive, and then you might have another year that was. And so when we tried to get in there and capture the triggers, then we saw it was revenue neutral in any particular year.
Okay.
If that makes sense.
All right. Thank you. Representative Zuber.
Thank you, Mr. Chairman. Corey, thank you for your time. You also told this committee that your study came to the conclusion that the House plan would increase population in Mississippi. Is that correct?
Yes.
And Corey, I think I know the answer to this, but is that because the House plan would make Mississippi more attractive to millennials and to remote workers? And if not, what would be the reason for the increase in population, please?
I think the increase in population is associated with our increase in total employment. Both of those are relatively small, associated with the relatively small increase in real GDP. There, like I say, there would be some marginal increases in employment, which I think both probably in the public sector and the private sector, and those would be associated with the increases in population. Now, I can't speak to how more attractive the state might look to certain groups because of that. I don't know that answer.
Any other questions? Representative Lamar.
One follow-up, Corey, if
Okay.
you don't mind, and if you don't know, then you don't know, but we focused earlier, a little while, I think Senator Brian mentioned a comparison of the $30,000 a year man versus the $300,000 a year man. And I would like to spend just a quick minute focusing on the average, which is the $40,000 a year. I shouldn't say man, person, lady, whoever. Do you know how much, just using that particular example, roughly how much of that income in a year average does someone spend on items that are subject to a sales tax?
I don't know that answer.
We don't know that. Okay.
I mean, if
all
I
I
could
have.
speculate, I would speculate that the higher income person would probably
Yeah.
be spending more income on services that aren't taxed
Yeah.
because they can afford that, whereas a lower income person probably would be spending more on goods.
I guess what I'm trying to determine here is I want to make sure that y'all included this in your model. Okay, so the facts are that the numbers are what they are. The $40,000 a year man pays right at $1,300 a year in income tax in the state of Mississippi currently. And so if we eliminated that, he would have $1,300 in his pocket. That same person spends roughly, numbers indicate nationally, would spend approximately $10,000, maybe up to $12,000, somewhere in that ballpark, on items that are subject to a sales tax. The odd year is when that person goes and buys a car that's, $40,000 a year person probably doesn't buy an $80,000 a year car, but they buy a car, that's the odd year, maybe every 5 or 6 years. Point being, that $10,000 that's subject to on items that is spent on items subject to a sales tax, the increase there would be $250 in additional tax under the plan we've discussed. And so that person saves $1,300 and spends an extra $250. I will caveat though, that does not include the cut in grocery taxes, which would likely offset, because about half roughly of that $10,000 is going to be spent on groceries. Somewhere, I'm using approximations. So it'd probably be an offset, but assuming it's not, my question is, in that scenario, that person has $1,000 roughly of additional disposable income in their pocket in that year. Does your model take that into account? How does your model figure out the additional money? Because that money is going to be spent in the economy here in Mississippi throughout that year. And that would apply to every $40,000 a year person in the state if this plan were enacted.
The model takes it into account in the aggregate. We didn't look at, it doesn't look at a particular individual. It does increase income, personal income for taxpayers in Mississippi as a result of eliminating that income tax, phasing it out. And it accounts for the increase in spending as done by the increase in the sales tax. So it's being captured in that, like I say, in the aggregate. We didn't look at how a particular individual at a particular level of income was affected.
It just seems to me, in my layman's way of thinking about it, you've got, I can't tell you the numbers, how many people in a year in the state of Mississippi make at least $40,000, but it's a lot of them. And if every one of those people has an extra $1,000 at a minimum to go spend in our economy, my common sense approach, it seems to me that would help the economy. Is that not correct?
Yes, in the aggregate, yes.
Okay, thank you.
All right, seeing no further questions, thank you, Corey, for being here today. And we will begin tomorrow morning at 9 a.m. So thank you all very much and see you tomorrow.